Welcome to my presentation, everyone. Good morning, everyone. My name is Mayang Labong Kalmexmaite, and today I am excited to talk to you about a crucial aspect of business management: sources of finance. Understanding these various avenues through which a business can secure funding is fundamental to its growth and sustainability. In this presentation, we will explore both internal and external sources of finance. I hope this presentation will provide you with valuable knowledge and practical strategy for managing and securing finances in your business endeavors. Thank you for your attention and let's get started. Sources of finance. There are two types of sources of finance. The first one is the external sources and second one is the internal sources. In the external sources play a pivotal roles in business growth and expansion. Key sources include issues of corporate securities, angel investor, crowdfunding, commercial bank, initial public offering, shortly IPOs. In the issue of corporate securities, there may be divided into three types: equity shares, preference shares, debentures, and bonds. In the equity shares are a primary source of finance contributed by the owner of the company. For new companies, promoters must first contribute to equity shares with the balance offered to the public. Existing companies can issue new equity shares through rights issues to existing shareholders or bonus shares from accumulated profits. In the preference shares, these provide a fixed rate of dividend and have priority over equity shares in the distribution of profits and assets upon liquidation. Debentures and bonds. These are long-term debt instruments used to interchangeably in India. They represent loans taken by the company which need to be repaid at a fixed interest rate. The second one is the angel investor. These are affluent individuals who provide capital to startup in exchange for equity ownership or convertible debt. They not only offer financial banking but also bring valuable expertise and networks to the business. Angel investors are particularly beneficial for early stage companies with high growth potential but limited access to traditional financing. Third one is the crowdfunding. This method involves raising small amounts of money from a large number of people, typically through online platforms. Crowdfunding can be a viable option for startups and small businesses to secure funds while simultaneously generating market interest and validating their products or services. It also allows business to gauge consumer interest and build a loyal customer base from the outset. Commercial bank. Traditional bank loans are a common source of external finance for business. Banks offer various loan products tailored to different needs, from short-term working capital loans to long-term financing for expansion. While bank loans require repayment with interest, they do not dilute ownership and can provide substantial funding for established business with good credit histories. Initial public offering. Going public by issuing shares on a stock exchange allows a company to raise large amount of capital from the general public. An IPO can significantly boost a company's financial standing and visibility. However, it also involves substantial regulatory compliance costs and shift in management focus towards shareholders' interests and market performance. Each of these external financing options has distinct advantages and challenges, and business must carefully consider their specific needs, growth stage, and long-term goals when selecting the appropriate sources. Next is Internal source of finance. The internal source of finance essential for the sustainability and growth of a business as they are derived from within the company itself. Key internal sources include personal savings, sales of assets, return earning, working capital, and owner's capital. Personal saving. This is often the first source of funding for many entrepreneurs. Investing one's own saving into the business demonstrates commitment and reduces reliance on external debt. It is straightforward but limited by the entrepreneur's personal financial capacity. Sales of asset. Business can generate funds by selling of non-essential or underutilized assets. This not this not only provides immediate cash but also helps streamline operations by focusing on core assets. However, it may limit future operational flexibility if essential assets are sold. Retained earnings. Profit that a business retains rather than distributing to shareholders are known as retained earnings. Reinvesting these profits back into the business helps fund expansion, innovation, and operational improvements without incurring debt. This approach is sustainable and indicative of a financially healthy company. Working capital. Efficient management of working capital, current assets minus current liabilities, can free up cash for business needs. Strategies such as faster inventory turnover, efficient receivable collection, and extended payable can enhance liquidity and finance daily operation. Owner's capital. Additional funds injected into the business by the owners beyond their initial investment. This infusion of capital can support growth initiatives and signal confidence in the business prospect to external shareholders. Utilizing this internal source of finance helps maintain control over the business, avoid interest costs, and reduce financial risks, fostering a more stable and self-reliant financial foundation. In conclusion, effectively managing internal and external sources of finance is crucial for any business growth and stability. Internal sources like personal saving and retained earnings provide control and reduce risks, while external sources such as angel investors and bank loans offer significant capital for expansion. Balancing these sources strategically ensures a strong financial foundation and supports long-term success. Thank you for your attention.